Hello, everyone. Thank you for joining us today. I'm Marcia Butler, the webinar director at Advice Chaser. Before we introduce our guest and get started, I need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box. We have a large crowd here today, so we may not be able to get to all of your questions today. If we're not able to address the question today, go ahead and leave your phone number in the chat box as well, and we're happy to have someone reach out to you after the event to make sure that gets addressed. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of today's material. I'd love to introduce you to our guest today, Matthew Sassani, a graduate of the London School of Economics, had 14 years of business management experience prior to joining American Express Financial Advisors, later Ameriprise Financial. As a financial consultant, he has been working with families and individuals, professionals, corporate executives, and business owners to help them plan, make well-informed decisions, and achieve financial success since 1999. In 2014, he founded Irvine Wealth Management as a full-service independent financial services firm with a special focus on retirement planning. Matthew and his team help their clients set up and manage their retirement plans that are best suited for their particular needs. At Irvine Wealth Management, Matthew and his team are dedicated to building long-term professional relationships based on trust, service, and knowledgeable advice. And Matthew, it's a pleasure to have you here to speak with us today. And let's go ahead and launch right into it. I'm excited for this webinar.
Thank you, Marcia. It's a pleasure to be here, and thank you everyone for attending our webinar today. And we're going to talk about retirement planning for people in their 50s and older. As you know, when we approach our 50s and beyond, our outlook towards our financial life changes. Instead of climbing the career ladder, or focusing on the accumulation, our thoughts may turn to, will I have enough to retire? A question I often am asked is, when can I retire? What if there is another economic downturn? Will I be able to withstand that? What benefits will I lose when I retire? If you have benefits at work and now you're going to lose them, and so how will I replace them? So those are some of the questions that I'm often asked regarding preparing for retirement. So as you well know, most of the climbing accidents actually happen on the climbing down, not on the climbing up of the mountains. The question of retirement is no different. As we are accumulating towards in our 50s, what we're doing is we're basically dollar cost averaging additional savings, and we're not looking to distribute that retirement account for a while, and constantly or typically our income is increasing as we gain more experience in our jobs or businesses. And of course, after retirement, that income goes away. The benefits of dollar cost averaging actually disappear, and instead you're at risk of market volatility when you are distributing your retirement incomes. So that's when the accidents can happen. So it's a totally valid set of questions that we asked before. can I retire? Will I have enough to retire on? And so on. And we're going to get into it a little bit here. I will keep the presentation in general terms. We don't get into a lot of details because in reality, everybody's case is different. And as a financial planner, when you do courses on financial planning, the very first principle is to get to know your client. So for the reason that everybody's case is different, everybody's preferences are different, and we need to actually get into the details of everybody's special situations before we can make a recommendation for that person or that family. So when we look at retirement planning, it's actually part of the whole comprehensive financial planning that we do. And in a comprehensive financial plan, we look at 6 areas of focus. The first thing is income planning, or essentially looking at your present financial position, assets, liabilities, and cash flow. The next item is risk management. And again, before retirement, what are the risks that one is facing or a family is facing? It has to do with health, disability, and life. If God forbid somebody is hit with a terminal illness, or as a result of an accident, they pass away, what will happen to the family? Investment planning, that essentially looks at intermediate goals for any savings and investments that you do. Sometimes you're saving up to buy a house, or buy a business, or do an investment of some sort. The next item is tax planning. What do I do for myself and my family to pay less in taxes, avoid taxes essentially? What kind of investments, what kind of vehicles are available to me that will save me in taxes, not only in a particular year, which is what your tax return professionals do, but over your whole financial lifetime. What can you do to manage your tax liabilities? It's about tax avoidance, and of course not paying taxes that you are due, not tax evasion, but tax avoidance. And of course, everybody's long-term goal is retirement planning, which is what we're going to focus on today here. And the final chapter or final item on comprehensive financial planning is estate planning. And we're going to look at each one of these items in some detail with the view that the retirement planning is the real focus. So focusing on retirement planning, the questions that come up right away, because housing is so important, is where do you want to live in retirement? A lot of times I have had clients that maybe live in California while they're working because of job, so because of opportunities for employment or business, but maybe they actually originally come from Tennessee or Texas or the East Coast or Middle America. And what they want to do is move back home after retirement, which completely changes the picture as far as the cost of living. So that's one of the important questions to ask. Where do you want to live? And what are your housing expenses in the new situation? Will you be able to, are you paying a mortgage right now? Will you be paying a mortgage in retirement? And of course, the question is, can I afford my present mortgage as it is after I retire and I stop receiving an income from my job or business? And finally, last but not least, is the question of when can I claim, or should I claim, Social Security? Of course, typically you can claim Social Security from 62 on, but at 62, you will be receiving a discounted level of Social Security. It is at full retirement age, FRA, essentially, that you receive your full Social Security. And every year after that, if you can wait before you actually take distribution, your Social Security income will go up by 8% a year, which is a nice little bonus. But the question is, should I do it? Should I not do it? So the decision when to trigger the Social Security is actually one of the most important, if not the most important, financial decision that you make for retirement. And so some of the items to think about is life expectancy, longevity in the family, history of longevity in the family, which all of these could be different for each person. So therefore, that would be an item for a conversation between yourself and your retirement advisor to make the best decision you can given the information that you have. So let's look at the items under the retirement planning. The first item was income planning. So a comprehensive financial plan takes into account your goals for the future, your net worth and cash flow, and assets and investments, and what kind of income they are generating, and then debts and obligations, one of which, of course, was, as we mentioned, your mortgage, and whether you have a mortgage after retirement or not. And believe it or not, we encounter situations where people still have student loans. They come with you no matter where you go and forever. So looking at all the debts and obligations and comparing the income that you are able to bring in with Social Security, pension, and investment income, and comparing with the obligations and the outflow of cash that you have for your expenses. The next item was risk planning. And as I said before, you look at health insurance, homeowners insurance, life insurance, disability, all of the things that you need while you're working. So what happens when you retire? The question is, will you still be working after your full retirement Social Security age, which typically right now is 67 or thereabouts, some people 66 and a half. And so what are the expected or unexpected unfortunate events that could happen and could change your financial picture, financial position? And in retirement, of course, the first question is, what will happen to my health insurance situation? Of course, we have Medicare, but there are also options regarding supplemental plans that can help you reduce the cost of healthcare in retirement. Sometimes you have work-related health insurance that can continue after retirement. In most cases, it does not, and you have to think about some kind of a supplemental plan that will help you. And there are many, and that's one of the questions that we constantly are asked, and we try and help retirees with the best decision they can make regarding that. Now, also, there are cases that we deal with single versus couples. If you're retiring as a couple, it's one set of issues. If you're single, it's a different one. Let me specifically address the question of long-term care. Of course, we all want to, as we say, live long and die fast. But statistics show that it doesn't quite happen that way. And a large percentage of people need some form of long-term care. So the question is, if we get into that situation, who is going to pay for it? The thing that I always mention is that the people who are at a much lower, very low levels of income, of course, you have Medicaid in California, Medi-Cal, that takes care of their long-term care needs. But and the people who are very wealthy essentially are self-insuring, and they decide that, okay, whatever the costs are, I can handle it. But in the middle, we have a large population that if they're forced to pay for long-term care, it's going to impact their retirement savings substantially, and that may cause some problems. Let me give you a typical example. If a couple, one of them needs long-term care, and they end up using a lot of the retirement resources to take care of the person who needs long-term care. And if that long-term care continues for a long time, which I've seen cases like that, especially with Alzheimer's patients who may last a long time, and they need care, obviously, and the family wants them to have the best care possible, but that may actually result in a lot of the retirement savings being exhausted, taking care of the first spouse that needs long-term care. And by the time that that first spouse leaves this earth, there's not much left for the second spouse to live on. So the retirement savings are exhausted just taking care of long-term care situation for one of them. And that's a real risk that one has to deal with and decide which way to go in terms of how to take care of such expenses. Also what we have is typically at retirement, we have two sets of incomes coming in. We have Social Security on both sides, we might have pensions on both sides, and we have some investments. And if both persons' Social Security is about the same, or if the pension plan that covers one of them is really just paying for the one person who earned the pension, when he passes or she passes away, the surviving spouse will be left with half of the income. And if the family expenses are such that the surviving spouse cannot really cut back expenses to the level that would be affordable, then we really have a financial crunch. And then the question is, how can we avoid getting into that kind of position? So these are some of the issues that we deal with under the risk planning topic within retirement plan. What are the risks that threaten a good retirement for both members of the family, for both sides of the marriage, just so that the surviving spouse will be as well provided for as when they were living together and they were both alive and well. The next item is investment planning within the comprehensive financial plan perspective. And what are the goals for investments? What are the time horizons? What is the risk tolerance associated with that? And what kind of asset allocation and diversification one should be looking at? Let me try to address this a little bit better. There are a lot of grandparents who like to pay for their grandchildren's education, or they might have a grandchild or even a child who is going to have a wedding expense. So how do we pay for that? So these are investment planning questions, in that they are intermediate goals. They could be within 2 years, within 5 years, that those expenses happen. And what kind of investments should we set aside and allocate for these kinds of expenses? And if and when that expense comes up, what assets should we liquidate? What distribution should we take? Should that come from IRAs and 401ks and retirement accounts, or should we have a non-qualified fund set aside for them so that it won't be taxable and it won't push up the tax bracket when you're liquidating to take care of that expense? Again, every case is different, and we need to look at that individually. The next item is tax planning, and let me look at the line items first, and then I'll explain what each one means. What type of accounts and assets are your funds invested in? And of course, as you well know, you could have IRAs, you could have Roth IRAs, you could have 401ks or Roth 401ks, you could have annuities that are tax deferred but non-qualified. You could have annuities that are qualified money, in other words, IRA or 401k money that you have rolled over into annuities. And distribution from them, each one has a different tax exposure. So let me explain that. If you have money, let's say in a savings account or in a CD in the bank, that is completely taxable. In other words, every year, whatever interest you're making on that savings account or CD, that's taxable. And then on the other hand, you have Roth IRAs that you do not have to distribute unless you really want to. It comes out tax-free as long as the money has been there for at least 5 years. And that is actually a kind of investment that can help you keep your tax bracket in check. And of course, most of us have, in addition to Social Security, IRAs and 401ks that are fully taxable as the money comes out of the retirement account. So in terms of managing your tax bracket, as you know, as we earn more or have more taxable income, even through distribution from retirement accounts, the tax bracket changes. So it's always prudent to have a certain amount of investment in non-taxable accounts like Roth IRAs, and there are other investments like municipal bonds, for instance, with respect to income, not with respect to capital appreciation, but with respect to income. These kinds of assets can keep your tax bracket in check. In other words, let's say in a particular year that you need $80,000 or $100,000 to live on, if a part of money is coming out of the non-taxable accounts like Roth IRAs, and then the rest of it comes out from the IRA, you can keep your tax bracket lower. So that's something that we try to manage for clients, so that by taking all of the distribution that they need, all of the income that they need out of the taxable accounts, they may be pushing up their tax bracket to a higher level. So that's something that can be done and should be done to avoid higher tax brackets as much as possible.
So I have a question here about this. When do you do this type of tax planning? So are you making a plan for the next year, or can you look at what's currently going on in your life and then plan out the rest of the year? Tell me how that works.
Excellent. That's an excellent question, actually. One of the reasons that you want to prepare for retirement long before you actually retire is to set up the accounts in good time and allow enough time for things to actually set in place and have a certain amount of weight within your portfolio. Let me explain that. Let's say you're 50 years old and you have all of your retirement savings in your taxable 401k. Or tax deductible 401k, as we call it. So it's tax deductible when you're accumulating, but once you start taking distribution, it's taxable on every dollar that you take, whether it is the principal that you contributed or the earnings that accumulated over the years. So one of the things that we do after retirement, especially, you can have control of your 401k by rolling it over into an IRA. Now you can decide what to invest it in and how to manage it from that point on. And one of the things that would be prudent to do would be to do some conversion from your traditional IRA to a Roth IRA and allow enough time for that to accumulate and appreciate. And as you're doing the conversion, of course, you'll be paying taxes in the current year. And again, you need to be careful how much of that money you're converting so that you're not pushing up your tax bracket in that particular year of conversion. But let's say now you're retired at 67 and you have managed to accumulate some funds in the Roth IRA, as well as having the money, the taxable money in the IRA. So after that, when you are taking distribution from the IRA, you can actually modulate that in such a way that you take part of the income that you need in any particular year out of the Roth IRA, which you accumulate through conversion or through direct annual contributions. And then part of the income that you need comes from the IRA. But it's not something that you can decide on the spot in any particular year, but you need to kind of plan towards it. So that's why actually this seminar is geared towards people who are 50 and over, and they're really now focusing on retirement and preparing for the day that they will be retired and they will stop receiving an income from their jobs. There are many reasons why, if you want to start planning for retirement, you should start earlier than later. Because when we get to that point, options are limited, choices are limited, and whatever investments or tax situations, etc., that you're in, you will have less time and less opportunities to change that picture to a more desirable profile, whether tax-wise or investment-wise, that can help you and help your investments to last longer in retirement. And the last item there on the list was the estate planning questions. And these are really questions that we rarely ever ask when we are much younger. But as we age, we realize that, okay, life is finite, and we do need to be mindful of the fact that if we're not in a position to make decisions for ourselves, whether we're through a surgery, going into coma as a result of a stroke, or Alzheimer's, which is more common than we would like to think, who is going to make those decisions for us, whether it is family decisions or financial decisions or health decisions? How are we going to get over that hurdle? How should we address that? And now for my retiring clients, we will have that conversation in details specifically. And then, of course, we will, once we have the blueprint of what needs to happen, what the clients would like to see happen, if they were not in a position to make decisions for themselves through death or disability or Alzheimer's or what have you, how is that, those questions, how are those questions are going to be addressed? Who is going to have access to their bank account, for instance, to pay for some of their expenses or debt and obligations? And then as far as if they were to pass away, what's going to happen to their assets? And more often than not, more often than you care to know, people pass away without proper estate planning, and that leaves a whole mess behind for their for the survivors to handle. Sometimes it gets to be a question of legal conflicts, or the state has to take over and go through a whole process that will take a couple of years or cost a lot of money to handle. So what you want to do is definitely have a comprehensive conversation with your advisor to make sure that you address all the questions that come up, and then put some legal paperwork in place so that if that sort of situation happens, their survivors know what to do and where to go with that, and how to handle the estate and how to handle your healthcare questions and the like. So the laws may change. The laws may not be exactly your friends in a particular situation, especially if you have had prior marriages and children from other marriages and so on. This can cause a lot of conflict, and I've seen just too many of those cases. So it's definitely one of the most important parts, even though we leave it for last, but it is not because it's not significant. It is very important to take care of that so that you can avoid all the unnecessary hassles and the results that are not desirable. So that's what we talk about within estate planning, and we make sure that that is all taken care of.
I know that we're going to round this out a little bit, and then we're going to take questions. I've already got some questions ready to go. And I do want to tell our attendees you're welcome to put more questions in the chat. You may not see everyone else's questions. We try to keep things private here, but go ahead and put those in the chat if you have more questions.
Excellent, very good. So now we come to this question of whether for retirement purposes you need to be working with a financial advisor, retirement advisor, or not. Do you need a financial advisor? There would be some individuals who maybe are in the business themselves or have a lot of experience with managing money and the like. So in those kinds of situations, you may say, okay, I can handle it myself. Or I have a family member, a son or a daughter that is going to help me, and so on. But you have to weigh the costs and benefits of having a financial advisor. It is definitely an expense, but also on the plus side, if you have a trusted financial advisor who I always say, first of all, cares about you, and second of all, has the professional knowledge and experience to do what is necessary to make this a successful retirement for you. So if you find someone that can help you and you trust them and you like to work with them, I think it adds a lot more benefits than the costs involved. And the idea is that, you know, when you retire, you don't want to have to worry about all the day-to-day matters of finance. And if you have a professional that is focused on helping you, that can make life a lot easier and give you the peace of mind, knowing that you're doing the best you can, and also have a point of contact for any questions, any doubts, any investment issues, etc., that come up. You worry about the market, you worry about all the risks that we have just went over, and am I properly allocated or properly positioned to deal with whatever risks may come my way during retirement. And you do need to have someone that you can go to. You can A, depend on their experience, and B, on the trust that you have in the relationship to be able to help you. So how can you choose a retirement planner? That's a very good question, and that's where an organization like Advice Chaser comes up. As a financial planner, what I really enjoy doing is helping my clients with their financial planning and with their investments, and that's where my focus is. And I don't want to spend a lot of time marketing. So that's why I have actually started working with Advice Chaser. There are professionals in their own field that can help you decide which financial advisor, which retirement advisor is right for you. So once you start talking with them, they can guide you through, okay, these are your concerns. This is your type of preferences and risk tolerance and time horizon and so on. And they try to match an advisor like myself with an investor, a retiree that is looking for professional help. And hopefully that they do a good job bringing someone like me together with you as investors and as retirees so that you can get the best results.
So we've got some good questions in. I'm just going to get started on them. We'll see how far we can get. All right.
Sure.
Can you talk about catch-up contributions? I understand that after a certain age, you can contribute more to your retirement accounts.
Excellent. That's a great question. Yes, this is a very nice provision that the government has added, the IRS has added, that for all retirement accounts, if you are older than 50, you can have what we call a catch-up provision or a catch-up contribution. For different types of retirement accounts, it is different. For traditional and Roth IRA, it's $1,000 over the top of the limit, which is $6,500 for this year. For 401ks and solo Ks and SEP IRA, it is $7,500 a year, which is very nice. And then for simple IRA, which is also a group retirement plan for smaller groups, is $3,500. So the catch-up provision applies to people over 50 years of age. And depending on your particular retirement plan, it's a different amount. So again, consult your financial advisor or the website of the IRS, and you should be able to figure out what is the amount that you can contribute over and above the regular limit.
All right, here's another question. When do you start converting your 401k to a Roth IRA? Is it something like 5 years before retirement or 10 years before? Can you talk a little bit about the timing there?
That's a great question. It varies again from person to person where you are in your income level and tax brackets. As I mentioned earlier, you don't want to convert from a traditional 401k or a traditional IRA to a Roth at a time that your tax bracket is very high. And if you're between two tax brackets, you want to maybe just convert enough that would not push you over the next tax bracket. So the earlier you start, the better. Sometimes people move from one job to another, which means that in that year that they're changing jobs, their income would be probably lower than the previous years or the future years. So that's a great time to make a conversion, because any conversion that you make from the traditional Roth, traditional 401k or IRA will imply more taxes for that year. But if your income is low in a particular year for whatever reason, you took a sabbatical or you're between jobs, that would be a good time to do some of that conversion at the time that your tax bracket is lower. But the more time you have, the better it is for you to do it. The 5-year thing that we mentioned is actually about any gains that you make on the Roth IRA. You can take a distribution from a Roth IRA at any time, but only to the tune of the principal that you contributed. If you want to take money out of the gains that you have made on your Roth IRA, that money must have been there for at least 5 years before you can take a distribution out of it. So that 5-year rule is for that purpose. But in terms of conversion, you essentially can convert any time, but the best time to convert is in a year that your tax bracket is lower. And the amount to convert would be to take you from the tax bracket you're in to the next one, but not over it. So it's a little bit of a delicate decision, and it'd be best to make that decision with proper care.
Okay, that's very interesting. And I'm assuming if your tax bracket, it's not going to go any lower, and you want to do that Roth conversion, you could go up to just under that tax bracket. Make sure you're not going over.
Precisely.
Okay, all right. So can you talk about, someone asked about annuities. I know we didn't mention them at all, but they're wanting to know what are the downsides of annuities. Maybe you can just cover what they are and then say why you may not want to do an annuity as opposed to getting into one.
Right. Well, actually, I'm in terms of whether an annuity is a good thing or a bad thing. There are always any financial instruments that you used for your investments, there are pluses and minuses. And the fact that they have been created is the result of a need for that particular instrument. So I'm not someone who is an advocate of annuities through and through, or someone who is against annuities through and through. Every one of these tools has a place. When you go to the tool shed, you have a lot of tools, and you use the one that works best for that particular application. The downside of annuities is essentially a couple. Some annuities are very expensive in terms of the internal expenses and so on. And the second downside is that when you invest in annuities, you essentially lock in your money for a period of time. And if you were to, let's say if the surrender period is 7 years or 10 years or 5 years, if you were to take substantial amounts of money out of that annuity within that time frame, you will be penalized. There's a surrender charge. But there's a certain amount, usually about 10%, that is surrender free each year. So, you know, to tell you that annuities are bad and you shouldn't invest in, that would be wrong. To tell you that you should put all of your money into an annuity, that also would be wrong. The question is to do a proper planning and look at the allocation that is suitable for you. And definitely each one of these investment instruments may have a place in your portfolio, but it is something that has to be studied and measured, and look at, again, the cost and benefit. What is the benefit of an annuity? It can give you lifetime income. Many annuities have downside protection, downside guarantee. So if you're worried about the market volatility and you don't want to have to deal with it, it's like any insurance, is an insurance product, and like any insurance, there are costs associated with it. But at the same time, you pay for insurance because you don't want to have a loss. And so from that perspective, you know, there are some pluses for the annuities. The downsides, as I mentioned, are essentially two: the costs associated with it. So if you're talking to someone about annuities, who you're going to buy an annuity, you need to figure out what you're paying for that. What are you giving up? And the second thing is that the money will be essentially locked in for a long time. That long time could be 3 years, could be 5 years, could be 7 years, could be 10 years, and in some cases much longer. Is that okay? Does that fit your other financial goals? What are your time horizons for that money? So what I always say is that all of these tools are created because there was a need for it, but at the same time, all of them are not created equal. Not all annuities fit all particular investors, and or for all purposes. So each one of them has a place, but you need to kind of study. That's why you do the planning ahead of time, and then you decide what portion of it I should invest in this instrument or that instrument, the stock market or the bond market or real estate or annuities. All of these are various vehicles that could be used, but they should be suitable for you as a particular investor.
All right. Again, more specific. That's why the more specific it gets, the less we can say, because it's individual to everyone. Yeah.
Oh, absolutely.
So here's another question. I don't know. This is maybe outside of this topic here, but I'm going to throw out the question, and if you don't know, we can go ahead and refer them to another webinar. If I want to do a 401k Roth conversion within 2 years of turning 65, I understand Medicare could cost me more if I go over a certain limit. I'm in this certain time frame, and I'd like to minimize the monthly cost of Medicare. Are there any other options? Talk about the timing of doing conversions, and the idea that, you know, that's going to also affect income qualifications for, or income, I guess, income for Medicare evaluation on premiums.
Mm-hmm. The impact of a little higher income on Medicare, I would assume you're talking about the cost of Part B, and that could be a cost, but essentially always Medicare looks at the last 2 years. And even if in a particular year your Medicare Part B cost goes up by a certain amount, which is usually not very substantial, and if that happens as a result of the conversion, you know, that goes away after a while. So it's not going to be forever if it goes up by, let's say, $20 or $30 a month, which is not really substantial compared to cost of health insurance before retirement. But even if that goes up, then after 2 years, it goes away. So definitely what I mentioned earlier is relevant in that if you want to do a conversion, do it in a year and to the tune, to the amount that does not create a lot of tax liability for you. And a lot of tax liability is a rough description, because for someone, $200 would be a lot. For another person, $2,000 would be a lot. So you need to kind of look at it and say, okay, if I did this, I know what the benefits are because I will have accumulation of non-taxable Roth IRA, but then what are the costs? And then you look at the cost, and either a financial advisor or a tax advisor, a tax preparer can help you figure that out. And then you say, okay, it's going to cost me X dollars, and that's too much, so I don't want to do it this year. Or no, it's not too much, and that's fine. There is a cost to doing business here, and I pay that, and then I will have a Roth IRA that is substantial, and it will not be taxable for the rest of my life. And a lot of people nowadays live to be over 90 years old. So if you're doing it at 65, you're talking about so many years that the money will be in the Roth IRA, accumulating, growing, and you don't have to worry about taxes or required minimum distribution. So it's always a question of cost and benefit, and definitely, you should give it a serious consideration. And the little additional cost of Medicare Part B should not be an impediment to making a substantial financial decision.
All right. Thank you so much. That was a little harder one. I'm glad you were able to handle that on the fly. So I know you work with a lot of retirees. Have you found that it's hard to go from the accumulation phase to the distribution phase? Do you find that retirees in their first couple of years really struggle with that transition? What is that like?
Oh, absolutely. I think that's a great question, and mostly we ignore it until it actually hits us. And the question is, if I'm going to retire from, what am I going to retire to? What am I going to do after retirement? It's not unusual for many clients that I've worked with to say, oh, I retired and now I am bored. So a great example is a fantastic high school mathematics teacher who said, in the years that I was teaching, I always dreaded that alarm clock going off because then I had to go to class. And then after I retired and I went around the world for a year and a half, I realized that I'm getting bored. I need to go back to the class. So then he signed off for being a substitute. And he said, every day when that alarm clock goes off, if I wake up before it goes up, I'm looking forward to the minute that it goes up and I can get up and dress up and go to the class. And so that definitely was one example. Another one that I had, which is quite interesting, is I have this wonderful couple who worked with me for about 20 years, and they lived here, close to me here in Southern California. And after they retired, and they had this beautiful home that they had fixed up, to the best. And a year and a half or so after retirement, they decided that they wanted to move to Oregon. And I was just totally surprised. So I called him and said, why do you want to change? I mean, this house is beautiful and everything is set up. We're getting bored. We want to do something new. And I can totally understand that. So yes, that question is important, and it's definitely part of the consultations that we always have with clients, and making sure that they realize that they need to have something to retire to, not just retire from, because it's all about enjoying life. And what we do and how we set up the finances is to back up the lifestyle and the kind of activities that they want to engage in after retirement. And that's actually one of the other reasons that you might want to consider seriously having a retirement planner with you, so that you can do what you like to do and what gives meaning to your life, while the finances you don't have to look at every day. You leave most of the decisions or the day-to-day decisions to your dedicated financial advisor, whereas you can then focus on how to enjoy life. Of course, that requires total communication so that your advisor is prepared to handle your cash flow needs and be prepared to answer your questions because they're prepared for some of the preferences and the goals and the tolerance for risk and so on that you have already shared with him.
All right. You mentioned a little bit about people who have debt and maybe going into retirement, they might have mortgage debt or even student loan debt. How do you typically handle that when you know that that's going to be the case?
Very important question. Very important question. And the whole thing about, everything that we have talked about rests on cash flow. If you have, as one of my friends used to say, happiness is positive cash flow. If you have positive cash flow, whether when you're working or when you're retired, that is the foundation of our financial happiness, essentially. So when we look at your expenses profile or your liabilities or your monthly budget, etc., we immediately notice that housing is a big chunk of that monthly expense. So after you retire and your income theoretically and typically will go down, how is that housing expense going to be handled? It's not unusual, in some parts of the country, the houses are very expensive. You might have a very valuable house and a big mortgage. But the difference between the mortgage balance and the value of the house can actually buy you a house in a different part of the country without any mortgage. So that definitely is one of the things to consider. If you come from Minnesota and you live in New York City or in Los Angeles, you might want to, consider moving back to Minnesota, where housing is a lot more affordable, or Iowa, or Georgia, or other places. So that's definitely one of those questions. And then at the same time, we have something called reverse mortgage. Personally, I don't do reverse mortgages, but sometimes the reverse mortgage is a way that you can avoid having the mortgage payments on a monthly basis and still live in your house for as long as you live. So there are pros and cons to every decision, especially if you have children that you want to leave a big chunk of money for or leave your house for them. If you do a reverse mortgage, you may lose a big chunk of the equity in that house or all of it. So it's, again, something that case by case has to be analyzed and decided upon. But you definitely want to pay close attention to that housing cost because often enough, it is a big chunk of your monthly expenses. So there are two solutions, essentially, to summarize. One is to look at reverse mortgage, and the other one is to look at the possibility of living in an area that is less expensive regarding houses.
I know that some people also choose to work part-time to bring in extra income as well, and things like that.
Oh, absolutely.
Well.
Yeah, totally. I mean, that's another way to supplement your income. I was more focused on the expense side of the equation.
Yeah.
But definitely, if you can do things to bring additional income, additional to pension and Social Security and investment income, that definitely can help and make expensive housing more affordable.
Yeah. All right. Well, I have a couple of questions here that maybe we'll round it out, and then we'll let our people go for have the rest of their day back. So do financial advisors help with estate planning? Can you talk about the role of financial advisors in that process?
Typically a financial advisor like myself is not a lawyer, so I cannot, I will not, because there would be somewhat of a conflict of interest, put an estate plan together for my clients in terms of the actual documents that do this. But I've been through enough of them that I know all the ins and outs, and we know the rules, and we know the pitfalls of any particular decision, potential pitfalls, I should say. So consequently, what I do with my clients is we go through what their preferences are, what they, who they want to have as their attorney, in fact, for healthcare decisions, for financial decisions in the short term, and then who they want their beneficiaries to be, and if they're set up a trust, a living trust, which we also call, which are also revocable trusts. In other words, you can always revoke the trust and change the or change the specifics of the trust. So we go through all the options as far as how to address the concerns that you have regarding estate planning or regarding a situation where you are not in control of your assets or your health and so on, and appoint people who can take care of those and put that all in paper. So we essentially, what I say is that we help clients put together a blueprint for how they want their estate plan to be. And then either they have an attorney, which I work with, or I help them hire an attorney, and I supervise that process to make sure that the blueprint that we came up with can be put into legal language and on paper as a estate plan that can withstand challenges of courts if there is ever a situation with that. But we go through the process as a part of the comprehensive financial plan to make sure that we both have a good understanding of how it should all work out if they were not in control of their health or their assets. And then we will also make sure that that will be done. There are a lot of times that estate plans are put together and they're faulty for the time or for the particular purpose that they want them. But what a financial planner can do, if they are familiar with all the pitfalls of estate plans, they can help you avoid such mistakes.
Okay, and then one more question about how financial or retirement planners work. Can you talk about the different type of fee structures? For example, someone's asking, do you or someone like you provide a fee-only service to consult on just retirement questions, or how does that work?
That's also a good question. Yes, definitely. If you're going to work with a financial advisor, you want to ask that question up front, and they need to be clear as far as what you're paying for and how they get compensated. And I'm very happy to share with you that I always start with a comprehensive financial plan. And the idea is that, first of all, any planning is better than no planning. And second of all, once we do the financial plan, which is not a transaction, but a process, I get to know you well and you get to know me well. And so consequently, in that process, we decide if we're right for each other in the sense of the skill set and the temperament and the personalities that are involved are a good match. And so that I do that financial planning for a fee, and we will decide that together when we are sitting down, and when I look at the case, and I can get an assessment of how many hours it's going to take to accomplish what we are setting out to do with regard to financial planning. I'm an insurance agent and a registered investment advisor. So we manage money on a fee basis, and we also handle your insurance needs. One thing to mention is that in this kind of a business, in this kind of relationship, there is always potential for conflict of interest. So the question is, who is a fiduciary and how do they handle their fiduciary responsibilities? I am a fiduciary, and as a fiduciary, you must recommend and act in the best interest of clients. So any recommendations that I make, whereas there could be commissions or fees associated with it, which would benefit me, but at the same time, we have to balance that because there's always going to be some fees. But if it is in the best interest of the clients, my clients usually want to make sure that I get paid a fair fee so that I can afford to spend the time and focus and energy to handle their finances and to deliver advice that is suitable for them. And by the same token, I'm interested in making sure that the clients are not paying too much either for the services or the investments that they're engaging in. So it's a
mutually beneficial. I see that.
Beneficial relationship that we both have to work on. And I'll be more than happy to answer all of those questions when we get to work together.
And I will say that having talked with many advisors throughout the country, every advisor is a little bit different in how they charge. Some do financial planning as part of their asset management. There's others who do fee for service. So one of the things that Advice Chaser offers is to match you with an advisor, and our advisor partners have a free consultation. And those are the kind of questions you can ask during the consultation to see if they're the right fit for you.
And if I may add this here, when you are paying a fee for a financial plan, which I always charge a fee for a financial plan, you're essentially getting into a fiduciary relationship. That financial plan, that financial recommendation has to stand on its own, whether you do further business with that advisor or not. So essentially, the way to make sure that you get good advice is that you hire a financial planner. That's my perspective. That gets paid for the advice that they deliver. So they spend the time, they look at the data that you give them, and they process the data and come up with calculations that are dependable, and they're not geared towards any particular investment. As far as the type of investments that I do for my clients, I do not make a decision ahead of time. It all depends on each case, and I'm agnostic as far as whether to use one product or one company or another investment. I'm an independent financial advisor, and I do not get paid more because I chose an investment for a particular company. My loyalty, I can say categorically, is 100% with my clients. And that's, to me, that's the kind of advisor that you want to have. An independent financial advisor that's not associated with a big brand name and is not loyal or captive to a particular company, but is loyal to you as the investor and as a retiree. And that's what I try to do.
Well, thank you. That's a good place to end. And I want to thank Matthew for being here, and for the organizations that have made this webinar possible today. Once again, we want to thank you for coming to our webinar today. Attendees, look for a link to the replay of this event. We'll be emailing that out to you. You're welcome to share that replay with your friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on Find an Advisor. Well, we're getting some thank yous in here in the chat, and we want to thank you all for being here. We hope to see you at another webinar soon. Goodbye, everyone.
Thank you very much. And thank you, Marcia, and everyone attending. It has been a pleasure to be with you this afternoon.